Let's slow this down, because the real development is being misread almost universally. And the misreading itself is what creates risk, not just for policymakers, but for markets that are still pricing this as a localized disruption rather than a systemic inflection. This is not fundamentally about Venezuela, and it is not about any single enforcement action or regime. What unfolded was the activation of a mechanism that had already been primed by years of accumulated pressure, and once that mechanism is engaged, the sequence that follows is no longer discretionary. When the United States tightened its control over Venezuelan oil flows, it did not simply apply pressure to an isolated producer. It demonstrated again how leverage is exercised in the modern financial order, not through direct confrontation, but through control of movement, access, and uncertainty. Oil is not just an energy input, it is a timing instrument, and when timing becomes unpredictable, entire balance sheets are forced to adjust. The shock did not remain regional because it never could. Venezuela sits inside a global system of supply, insurance, shipping, and settlement, and disrupting one node transmits stress across all of them simultaneously. For China, this was not an abstract signal. Venezuelan crude had been quietly integrated into its energy strategy precisely because it was discounted, politically constrained, and therefore exploitable under the existing order. That integration was not opportunistic, it was structural. Once that flow was disrupted, the issue ceased to be about barrels and became about exposure. Exposure to a system where physical supply chains remain vulnerable to a single enforcement architecture. That realization changes incentives immediately. The United States possesses unmatched capacity to project power over sea lanes, but that capacity is not free, and more importantly, it is not invisible to markets. Every enforcement action injects uncertainty into shipping decisions, raises insurance costs, delays settlement, and forces traders to price risk that previously sat below the surface. Those costs accumulate long before they appear in official statistics. They show up first in behavior. Ships reroute, contracts are rewritten, coverage is withdrawn. What appears as compliance is often just rational avoidance. This is how modern economic pressure actually works. It does not require universal enforcement, only sufficient uncertainty to make participation irrational. Inside Venezuela, production slows, not because oil disappears, but because storage saturates. Outside Venezuela, refiners begin recalculating margins, inventories, and substitution costs. For China, this recalculation is immediate and unavoidable. Heavy crude is not interchangeable overnight. Refining systems are optimized over years, not weeks, and disruption at this level is not a nuisance, it is a constraint. This is where the confrontation changes character. China understands that responding symmetrically is inefficient and escalatory. Matching naval presence does not solve the underlying vulnerability. The vulnerability is systemic, not tactical. Physical supply chains can be throttled by a rival that controls access, and once that is understood, the response shifts domains. Finance becomes the arena because finance is where asymmetry is cheapest and most scalable. Currency, capital flows, and settlement systems operate faster than fleets and at far lower political cost. This is not a reaction driven by emotion or retaliation. It is a recalibration driven by arithmetic. The United States can impose pressure through control of movement, but doing so requires sustained expenditure, higher deficits, and continued absorption of risk by its financial system. Those costs are financed through debt, and debt must be absorbed by markets whose confidence is not infinite. This is the exposure China recognizes. While Washington focuses on physical enforcement, Beijing focuses on positioning its financial system as an alternative margin of safety for capital that is increasingly sensitive to geopolitical friction. This does not require a declaration or a dramatic policy shift. It requires signaling tolerance, tolerance for currency strength, tolerance for inflows, tolerance for diversification. A currency that is allowed to appreciate communicates confidence in internal stability and willingness to absorb external pressure. That signal matters enormously to investors who are no longer evaluating risk in isolation, but in system terms. The moment energy is weaponized, finance is politicized by default. Every investor, every reserve manager, every multinational treasury becomes a participant, whether they intend to or not. Capital begins to move, not because it expects collapse, but because it expects friction. Friction changes optimal allocation. The United States may assume that pressure remains contained because domestic impact appears limited, but markets do not evaluate cost locally. They evaluate it structurally. High enforcement intensity paired with persistent deficits creates a visible trade-off. Power is being exercised, but it is being financed. Financed power is powerful only as long as markets remain willing to underwrite it without demanding a premium that constrains future action. This is the threshold being approached now. The oil disruption was the trigger, not the objective. It revealed dependencies that had been tolerated under conditions of stability but become unacceptable under conditions of coercion. Once those dependencies are exposed, adaptation is inevitable. And adaptation does not reverse when pressure eases. It compounds. What looks like a narrow enforcement action is, in reality, a demonstration of how leverage functions and what it costs. Once that demonstration is internalized, the response is not loud, not immediate, and not theatrical. It is methodical. It unfolds through markets, through balance sheets, through gradual shifts in preference and settlement. This is how a currency war begins, not with confrontation, but with reallocation, not with collapse, but with erosion. And once that process starts, it does not require escalation to continue. It only requires repetition. What follows from that initial disruption is not immediate retaliation or visible escalation, but a deeper recalibration that operates below the level of headlines, because once a system reveals that access can be conditioned, every actor inside that system begins quietly preparing for the next constraint rather than debating the last one. This is where most commentary loses the thread because it looks for announcements instead of adjustments, and for declarations instead of incentives. The United States demonstrated that it can still interfere with physical flows of energy at will, but in doing so, it also reminded every major importer that their exposure is not theoretical. That reminder changes planning assumptions instantly. Energy buyers do not wait for shortages to appear on screens. They respond to risk before it materializes, because the cost of being late is always higher than the cost of acting early. Once Venezuelan oil exports became uncertain, the reaction spread through procurement desks, logistics teams, and financial hedging operations simultaneously. Refiners adjusted input forecasts. Traders widened risk premiums. Insurers rewrote coverage terms. None of this required coordination. It happened because the system is designed to respond defensively when uncertainty rises. This defensive behavior is what turns enforcement into leverage. The irony is that the more effectively enforcement works, the more it incentivizes adaptation away from the structure that made enforcement effective in the first place. China's planners understand this dynamic intimately. They do not interpret disruptions as isolated events, but as data points in a broader pattern of how pressure is applied and where vulnerabilities reside. The Venezuelan case confirmed something Beijing had already internalized, that reliance on seaborne energy flows governed by another power is a structural weakness that cannot be fully hedged with contracts or diplomacy. Once that conclusion is reached, the response shifts from operational fixes to systemic ones. You do not solve a systemic vulnerability by buying from a different seller if the route and enforcement architecture remain the same. You solve it by reducing exposure to the architecture itself. That is why the response moves toward finance rather than logistics. Finance is where dependency can be diluted without confrontation. Capital markets allow pressure to be applied indirectly, incrementally, and plausibly deniably. Currency policy, in particular, operates as a signal amplifier. When a major economy signals that it is comfortable with a stronger currency, it is not simply adjusting an exchange rate, it is inviting capital to reconsider where safety and stability reside. This matters because capital is highly sensitive to narrative consistency. A currency that is allowed to strengthen in the face of external pressure communicates internal confidence and policy discipline. At the same time, it reframes the cost-benefit calculation for holding assets elsewhere. Investors begin comparing not just yields, but the conditions attached to those yields. High yields financed by rising deficits and expanding enforcement commitments begin to look different when juxtaposed with assets backed by a state signaling long-term strategic coherence. This does not trigger a sudden exodus. It triggers reassessment. Reassessment leads to diversification. Diversification leads to reduced dependence. Reduced dependence weakens leverage. This sequence is slow, but it is relentless. The United States remains at the center of the system, but its position is increasingly contingent on continued market tolerance for the costs of maintaining that center. Those costs are no longer invisible. They appear in debt issuance volumes, in interest expense projections, and in political constraints that limit fiscal flexibility. Markets see this even when policy rhetoric denies it. This is where the asymmetry becomes decisive. China does not need to match enforcement action for action. It only needs to allow the system's internal logic to work. By refraining from dramatic responses and instead adjusting incentives at the margin, it benefits from the cumulative effect of others' risk management decisions. This is not escalation, it is absorption. Absorption of capital, of optionality, and of influence. Once absorbed, these do not return easily. The enforcement action against Venezuelan oil flows therefore accomplished more than its immediate objective. It accelerated a process that was already underway by making the cost structure of dominance more explicit. Every actor watching understood the message, even if they did not articulate it publicly. Access is conditional, enforcement is effective, but effectiveness has a price, and when that price rises, the system adapts. This is the phase where adaptation becomes the dominant force, quietly reshaping incentives while attention remains fixed on the visible theater. The third stage begins when these adaptations stop being precautionary and start becoming embedded assumptions. Because once actors adjust, not for a specific disruption, but for the expectation of future ones, the system itself has changed even if no one announces it. This is the point where risk management quietly turns into strategic positioning. What had initially been treated as a contingency becomes a baseline, and baselines drive long-term decisions. Energy buyers no longer ask whether a supply route might be disrupted. They ask how often and at what cost. Financial institutions no longer assume frictionless settlement. They build buffers for interruption and policy interference. Governments no longer treat access as guaranteed. They treat it as conditional and therefore politically priced. These shifts do not generate headlines, but they generate inertia, and inertia is one of the most powerful forces in financial systems. Once new assumptions are baked into contracts, mandates, and allocation frameworks, reversing them requires more than reassurance. It requires time and credibility, both of which are in limited supply during periods of rising structural tension. This is where the consequences begin to compound. Capital that once flowed automatically now hesitates. Liquidity that was once taken for granted becomes episodic. Volatility increases not because fundamentals have collapsed, but because certainty has. The dominant system's challenge in this phase is not loss of capability, but loss of optionality. Every policy response still works in isolation, but each one constrains the next. Higher rates defend currency, but strain fiscal dynamics. Fiscal expansion supports growth, but deepens dependence on external financing. Enforcement preserves leverage, but accelerates diversification. There's no neutral move left, only trade-offs. Markets sense this narrowing corridor intuitively. They begin pricing policy outcomes not on stated intent, but on political feasibility. This is a critical shift. Once feasibility matters more than theory, long-term confidence becomes harder to sustain. China's position in this phase is structurally advantaged because it is not managing an overextended system. It is shaping an alternative margin within it. By maintaining strategic patience and avoiding overt confrontation, it allows others to move first. Every investor reallocating even marginally does so for their own reasons, but the aggregate effect benefits the same destination. This is how influence accumulates without coercion. Currency plays a central role here because it sits at the junction of trade, capital, and confidence. A currency that is permitted to strengthen sends a signal that the issuing state prioritizes stability over short-term export advantage. That signal is powerful in an environment where many economies are implicitly prioritizing short-term political objectives over long-term balance. Investors do not require perfect transparency to respond to this. They require consistency. Consistency reduces model error. Reduced model error attracts long-duration capital. Long-duration capital is sticky. Once it arrives, it alters market depth, improves liquidity, and reinforces the very stability that attracted it in the first place. This is the feedback loop now forming. Meanwhile, the dominant system must continuously reassure markets that its growing obligations remain manageable. Reassurance requires communication, but communication cannot override arithmetic indefinitely. Rising debt servicing costs, expanding enforcement commitments, and political polarization all feed into perceptions of future constraint. These perceptions shape today's pricing decisions. This is why the third phase feels disconnected from the original trigger. Oil flows may stabilize, headlines may shift. But the internal recalibration continues because it is no longer about Venezuela or any single enforcement action. It is about what the system revealed about itself. Once revealed, that information cannot be unlearned. The system has shown that access is conditional, that enforcement is effective, and that effectiveness carries a financial cost borne unevenly over time. Rational actors respond to that information by reducing exposure where they can and increasing resilience where alternatives exist. None of this implies imminent collapse or abrupt transition. It implies drift away from exclusivity, drift toward redundancy, drift toward a more distributed allocation of confidence. Drift is slow, but it is relentless. In financial systems, drift matters more than shocks because it reshapes expectations gradually without triggering defensive responses that might otherwise halt it. This is why the third phase is the most dangerous for incumbents and the most advantageous for patient challengers. By the time the effects are visible in aggregate data, the underlying behavior has already changed. Policymakers may still be debating causes, but markets have already acted on consequences. At this stage, the contest is no longer about who can apply pressure, but about who can endure the costs of applying it longer without forcing their own system into tighter constraints. That is the quiet question now being priced, day after day, across currencies, bonds, and capital flows. The fourth phase emerges when this gradual drift begins to feed back into institutional behavior in ways that are no longer purely market-driven because, once enough, private actors adjust their assumptions, public institutions are forced to respond whether they acknowledge the cause or not. This is where the distinction between market dynamics and policy dynamics starts to blur. Central banks, treasuries, and regulatory bodies do not operate in a vacuum. They react to conditions that are increasingly shaped by prior reallocations of capital, liquidity preferences, and risk tolerance. When capital becomes more selective, funding conditions tighten unevenly. Some jurisdictions experience inflows that deepen markets and lower volatility. while others face higher marginal funding costs even if their headline indicators remain strong. This unevenness is destabilizing, not because it signals weakness everywhere, but because it introduces divergence where convergence was previously assumed. Divergence complicates coordination. Coordination failures amplify uncertainty. Uncertainty feeds back into markets. This loop is now becoming visible. The dominant system's institutions find themselves managing outcomes rather than shaping them. Policy tools that once guided expectations now chase them. Forward guidance loses traction when credibility is questioned not on intent, but on capacity. Capacity is constrained by balance sheets, politics, and external commitments that cannot be unwound quickly. This is why policy responses begin to look reactive even when they are carefully planned. Markets sense this shift immediately. They begin to test boundaries, not aggressively, but persistently. Small stress events that would once have been absorbed now propagate further. Liquidity pockets thin out. Bid-ask spreads widen in moments of uncertainty. These are not crisis signals, but they are friction signals, and friction is what investors are increasingly pricing. In contrast, systems that are perceived as building resilience rather than projecting control benefit disproportionately in this environment. China's approach in this phase is to let institutional gravity do the work. By steadily expanding the usability of its financial infrastructure, improving settlement efficiency, and signaling long-term policy continuity, it makes itself incrementally more attractive without demanding trust all at once. Trust, in financial terms, is never granted wholesale. It is accumulated through repeated interactions that do not end badly. Each successful settlement, each period of currency stability, each episode where capital enters and exits without disruption adds another layer. Over time, these layers form a foundation that can support larger flows. This is how parallel systems mature. They do not replace incumbents through confrontation, but through competence. Meanwhile, the incumbent system must contend with rising internal contradictions. It is expected to provide global stability while absorbing global risk, to enforce rules while remaining neutral, to project power while maintaining fiscal discipline. These expectations were manageable when capital was captive and alternatives were thin. They become harder to meet when capital is mobile and alternatives are credible enough to matter. The result is policy strain. Decisions become more politicized. Trade-offs become more visible. Visible trade-offs undermine confidence even when outcomes are managed successfully. Investors are not alarmed by trade-offs themselves, but by the frequency with which they must be confronted. Frequent trade-offs signal a system operating closer to its limits. This perception shapes long-term allocation more than any single data point. As the fourth phase unfolds, the narrative environment also begins to change. What was once dismissed as hypothetical diversification becomes framed as prudent risk management. What was once labeled fragmentation becomes reframed as resilience. Language matters because it legitimizes behavior. Once diversification is socially and institutionally acceptable, it accelerates. Institutions that were previously constrained by convention begin to move. Reserve managers adjust bands. Corporations revisit invoicing practices. Multilateral arrangements quietly incorporate optionality. None of this is coordinated, but it is mutually reinforcing. The dominant system can still exert influence, but influence exercised against a backdrop of rising alternatives requires greater effort for diminishing returns. This asymmetry becomes increasingly difficult to ignore. The fourth phase, therefore, is not about collapse or replacement. It is about institutional fatigue on one side and institutional accumulation on the other. Fatigue does not imply failure. Accumulation does not imply dominance. But together, they alter the slope of the system's trajectory. Once that slope changes, momentum follows, and momentum, once established, is far harder to counter than any single policy shock. The fifth phase is where the long-term implications of this shift begin to influence strategic behavior in ways that extend beyond markets and into the core planning assumptions of states, corporations, and financial institutions. Because once confidence is no longer concentrated in a single center, every actor must assume a more complex operating environment. This is the phase where optionality becomes a priority rather than an optimization, and where resilience is valued above efficiency. Systems built for maximum throughput under stable conditions begin to be redesigned for endurance under contested ones. For corporations, this means reassessing not just suppliers, but currencies of account, funding sources, and legal jurisdictions. For financial institutions, it means stress testing portfolios against scenarios that were previously considered remote. For states, it means reevaluating how much leverage can be applied externally without generating internal constraints that offset the intended gains. These shifts are subtle, but they are profound because they alter how decisions are made at the margin. The dominant system AS challenge in this phase is that its tools were designed for a world of high confidence and low redundancy. Sanctions, enforcement, and conditional access are most effective when alternatives are scarce and coordination is easy. As redundancy increases, coordination becomes harder and enforcement becomes less precise. Precision matters because blunt pressure generates unintended consequences that feed back into the system. Investors do not fear pressure itself, they fear unpredictability in how and where it will be applied. The more often pressure is used, the more unpredictable it appears, even if the underlying rationale is consistent. This unpredictability is corrosive to confidence. China's approach in this phase is to position itself as a stabilizing counterweight, not by promising immunity from risk, but by offering predictability in how risk is managed. Predictability does not require openness in every dimension. It requires coherence. A system that is coherent can be modeled. A system that can be modeled attracts capital. Capital that arrives, for modeling reasons, is less likely to flee at the first sign of stress. This is the kind of capital that deepens markets and reduces volatility over time. Meanwhile, the incumbent system must contend with rising complexity in its own decision-making. Domestic political cycles, fiscal constraints, and external commitments intersect in ways that limit flexibility. Policy decisions become more contingent, more negotiated, and more reactive. Even when outcomes are rational, the process appears unstable. Markets care about process because process determines future response speed. Slower, more contested processes increase perceived risk. This perception influences long-term positioning more than near-term performance. As the fifth phase progresses, the cumulative effect of diversification becomes visible in data that once seemed immutable. Currency shares adjust gradually. Settlement patterns evolve. Capital market correlations shift. None of these changes on their own are dramatic. Together, they signal a system in transition. The dominant currency remains central, but it is no longer the sole reference point. That shift alone alters bargaining dynamics across the global economy. States and corporations gain incremental leverage simply by having options. Options reduce vulnerability. Reduced vulnerability weakens coercive tools. This feedback loop is now well underway. The strategic implication is that power is becoming more diffuse, not because it is being seized, but because it is being hedged against. Hedging does not eliminate dominance, but it limits its reach. In this environment, patience becomes a strategic asset. Actors who can tolerate slower gains in exchange for greater resilience position themselves advantageously for the next phase. Actors who insist on maximizing short-term leverage risk accelerating the very adjustments that reduce their influence over time. The fifth phase, therefore, is defined by a quiet but consequential reweighting of priorities, away from speed and toward sustainability, away from control and toward adaptability. This reweighting does not produce immediate winners or losers, but it reshapes the field on which future contests will be decided. The sixth and final phase is where the consequences of everything that preceded it begin to harden into a new operating reality. Not because a new order is declared, but because behavior has changed enough that reverting becomes impractical. At this stage, the system is no longer in transition, it is in adaptation. The assumptions that governed decision-making at the beginning of the process no longer hold, and actors who continue to operate as if they do are gradually penalized by outcomes that feel arbitrary only because the underlying logic has shifted. This phase is defined less by disruption and more by normalization of what would once have seemed exceptional. Diversification is no longer a hedge, it is a default. Redundancy is no longer inefficiency, it is insurance. Optionality is no longer a luxury, it is a requirement. Markets reflect this normalization through pricing structures that embed geopolitical and institutional risk as permanent features rather than temporary distortions. Volatility does not disappear, but it changes character. Instead of spiking only around crises, it becomes a background condition that flares episodically when constraints are tested. For the incumbent system, the defining challenge in this phase is managing influence without overextension. The tools of enforcement remain available, but their use now carries clearer opportunity costs. Each application of pressure is weighed not just against immediate objectives, but against its impact on long-term credibility and system cohesion. This does not eliminate leverage, but it disciplines it. Discipline is not imposed externally. It is imposed by the system's own constraints. Now, for China and other actors benefiting from diversification, the challenge is different. It is not about replacing the dominant system, but about integrating into a more plural environment without triggering instability that would undermine the very gains diversification has delivered. This requires restraint as much as ambition. Parallel systems must prove they can absorb stress without exporting it. Credibility in this phase is earned through performance under pressure, not through rhetoric. Over time, successful performance builds trust, and trust enables deeper integration. This is how the new equilibrium consolidates. It is not dramatic, and it is not symmetrical. It reflects accumulated behavior rather than negotiated agreement. The dominant currency remains important, but it operates in a more competitive landscape, where confidence is distributed rather than concentrated. This distribution does not end dominance, but it limits unilateralism. For global markets, this environment is more complex, but also more resilient. Shocks are less likely to cascade uncontrollably because exposure is spread. At the same time, predictability is reduced because no single actor can unilaterally stabilize every domain. The trade-off between control and resilience is now explicit. Actors who recognize this trade-off and adjust accordingly are better positioned to navigate the next cycle. Those who do not may find that tools which once delivered decisive outcomes now produce diminishing returns. The final phase, therefore, is not an ending, but a settling. The system does not collapse, it recalibrates. Power does not disappear, it diffuses. Influence does not vanish, it becomes conditional. The events that initiated this process will recede into history, but the behavioral changes they triggered will persist. This is how structural shifts in global finance actually occur, not through declarations or crises alone, but through the slow accumulation of adaptive choices made under constraint. Once that accumulation reaches critical mass, the system moves forward on a new trajectory, and returning to the old one becomes not impossible, but increasingly costly.